And with that, I'm going to introduce Will Mixon. He's with the Office of State Budget and Planning, and he's going to be talking about oil and gas economics and state and local government revenue impacts. Thank you, Will.
Okay. Thank you, Kirby. Thank you, Garfield County, Colorado Mesa, for having me. This is my third year out here, and it's always a place where I get a lot of great information myself, so I hope I can pass along some here today as well. My name is Will Mixon. I work for the State Budget Office, otherwise known as the Office of State Planning and Budgeting. I'm a revenue manager and principal economist in the office. Our team works on the quarterly economic and revenue forecast that we present to the and publish to the legislature and the Joint Budget Committee. And so basically what we work on are the revenue estimates that then inform the budget making process. So with that, we spend quite a good amount of time in the energy space and the oil and gas world on understanding the economic side and understanding the revenue impacts to the state. And so that's a lot of what I'm going to talk about here today. I'm going to start talking about last year versus this year. There's been it's been a very fluid environment. We'll talk about the U.S. and Colorado oil and gas market performance and outlook. We'll talk about short to medium term expectations over the next couple of years. And then we'll talk through some of the tax revenue sources, state oil and gas revenue sources, and we'll talk about local revenue oil and gas as well there at the end. So starting with last year versus today, what's changed? What kind of came in as expected? I mean, I think, so last year when I was here talking, tariffs were the big conversation. On April 2nd last year is when quote-unquote Liberation Day took place. There was a big tariff announcement, and oil prices really dropped on those expectations, on those announcements that that oil prices would be lower, and there was also, at the same time, OPEC was lifting production cuts, and so there was really this mindset that, well, we might be going into a lower oil price environment. And over 2025, oil prices were around average. They averaged about $65 a barrel. The IEA this time last year expected them to be at 64, ended up being a little bit better. They expected production at 13.5 million barrels per day, ended at 13.6. Overall, the market remained relatively resilient. Prices did dip below average toward the end of this past year, but mainly we're in the average levels and production grew. This year, there's uncertainty, but it's in a totally opposite direction, where the war in Iran is causing supply disruptions within the Strait of Hormuz. And so with that closure shipping through the Strait, we've seen prices really spike, oil prices spike. And so they've gone to over $100 a barrel right now. This morning, they look like in the low 90s. They've been all over the place over the past few weeks. And I'll just mention here that this presentation was put together the weekend before last, so obviously things have changed since then as well, and so we'll talk through that too as we move through here. So one of the things that have changed are oil price expectations, and so that orange line on the chart there shows what the Energy Information Administration last April thought oil prices would be in 2026. The blue line shows where the futures market curve currently sits as of April 4th. As you can see, price expectations very different now. Not only is there the expectation of the large spike in these next couple of months, but expected to be higher prices for a longer period of time throughout the year. So back last year, the IEA expected prices around $55 to $60 a barrel. They were pretty close to that in January, but of course that changed dramatically once the war began at the end of February. And so we're in a very different price environment now. I will just say the futures curve obviously changes every day, and that May contract has actually gone down below 100 now. So you can see it was like at 110 when I put this together. It's a little under. It's in the 90s now. So obviously things are changing, and trying to put together a timestamp in these markets are always tough, definitely when there's a lot of things moving. But the main concept remains that prices are expected to be higher. And so then zooming out a little bit on oil prices, of course, we see the big spike here in the recent days, but generally speaking, it hasn't reached those 2022 levels for a sustained period. So average annual oil price is $65.39, 10-year average $65. And then to begin this year, they were at $60, $64 before jumping to $90 in March. And I think on this, there would be some expectation that because of the closure of the Strait of Hormuz, that prices would actually even be higher than what we saw in 2022 because there is so much supply that's being taken offline. I think part of what part of what the kind of consensus is around that is that we kind of entered this period in a little better position on the supply side. So there were more buffers. There was really an almost oversupplied market where you had prices dipping below average. So we went into this as a globe, as a world, as a global oil supply in a better position than we did back in 2022 when we were coming out of COVID. Supply was a little tighter. And so that had more of an impact. Of course, the longer that this were to go on, those prices probably would at some point be sustained at the $100+ barrel for longer. Where we have seen more of a kind of a price pressure is in a lot of the refined products, primarily jet fuel and diesel. It's really seen some big spikes, and there's more of a supply crunch there. There's been some Middle East refining taking offline, and so there's been a little bit more of a supply crunch there where we've seen huge jumps. And of course, prices have certainly spiked in the oil market, but if you would have told people this time last year that the Strait of Hormuz would be closed when we sat here today, you probably would have thought oil prices would be even higher than they are. So the market kind of has taken this so far pretty well, where prices haven't really gone through the roof as much as you would expect. So looking at oil production, the U.S. did set the annual oil production record again this past year in 2025. That's the third consecutive year. Grew at 2.4%. In 2024 and 2025, growth has moderated. In 22 and 23, there was really a big jump coming out of the pandemic and coming with the Russia and Ukraine war. We saw some jump in production. It's still growing, but it has moderated some. And so the blue line on the chart shows the U.S. and the orange line is Colorado. I'll get a little bit more into Colorado here in a bit. But Colorado did see slightly positive growth in 2025. It was the second highest production year on record, however, still sitting about 20 million barrels shy of the 2019 levels. So then looking at state production rankings, these have remained pretty steady. Colorado sitting in the fourth position, has been there the past couple of years, makes up about 4% of overall domestic production, leaving aside offshore production. Texas, of course, remains leader at 49%. However, New Mexico continues to grow in its share, grow in its production, grow in its overall domestic share of production. And that's been a really interesting note. And this next slide kind of gets on to that point, that New Mexico oil production has more than doubled since 2019. It's added more barrels than Texas has over that same time period. And so, when we talk about the oil production growth in the U.S., it is being led by the Permian Basin. And so what is really interesting little note there is that on the far left side of the chart, you see New Mexico actually has added more barrels since 2019, more than the U.S. has as a whole. And so how is that? Is because there's a lot of states that have had declining production, have lower production since 2019. North Dakota production 19% lower, Oklahoma 32% lower, California is 40% lower than 2019, and Colorado is roughly about 90% of 2019 production levels. And so it's just kind of, I found that interesting, and I put together a similar chart like this last year. This is a little different, but I just find it interesting because a lot of the growth is coming out of the Permian, but and then New Mexico is really just a kind of a star within it. And then regionally, Utah and Montana have seen some increases since 2019 as well. And then looking at the map of Colorado oil production, this one I always re-up every year. So it's kind of an interesting graphic. Of course, Weld County is where the centralized oil production is, about 82%. Jason, yes. 82%. And so, and then in Adams and Arapahoe, you see some significant production as well. And then Rio Blanco, the 1% to 2%. But basically, kind of that color gradient gets you, orange, red to orange to yellow to green to blue, kind of gets the gradient of where production stands. And so, as I said, Weld County is about 80%, 82% of statewide production. Adams County is second at 7.5%, Arapahoe at 4.5%. And so you can see that certainly the blue bar on that chart represents Weld County. The orange represents the other counties. So you can see that breakdown, but you can also see kind of how the overall statewide production has gone. So if you just put them together, that's overall statewide production. You see the 2019 peak that stepped down over 2020 and 21. And then you see this kind of slow growth trajectory that the state has been on since then. So a bit of an uptick every year, but not up to the 2019 level at this point. So then natural gas production. So U.S. also set natural gas production record in 2025, grew 4.1%. This has been broader-based growth than just the Permian. It's more than a Permian story. Appalachian, Haynesville basins also growing significantly. And the chart kind of shows this itself, but you can see the Colorado growth has looked very different. It's still off the record highs by about 6.5% on an annual basis. Production has basically been flat since 2021. Saw a little bit of growth in 2025, about 1%. But certainly the U.S. and these basins have seen a lot of gas production growth, and so a lot of that is there's both the associated gas component, but there's also just a straight gas component as well. And definitely over this past year in 2025, where prices were a little bit at a higher level than they had been in 23 and 24. And this kind of shows this. So we saw weakness in 23 and 24. And then over 25, we did see more of an increase in natural gas prices, definitely over the winter months. While Colorado didn't see much of that cold, there was some cold snaps, certainly in the eastern half of the U.S. that led to a lot of demand spikes and led to some increasing prices. Overall, averaged $3.52 per million BTU in 25. That's Henry Hub, after being at $2.19 in 2024. And then we saw, as I mentioned, those winter months saw that jump to $7.72 in January. Now, this is a market that we have not seen the same impact from the Iran war. The spot prices right now are at or below $3. You know, the average, it's about $3.25, 10-year average. And so why is that? Well, the U.S. natural gas market is more of an island than the oil market. You know, we certainly, there's a global oil market. The U.S. imports quite a bit of oil. On the natural gas side, not so much. So we've been pretty insulated from what Europe and Asia are seeing on the natural gas side. And so prices have remained pretty even below average. And so also I've also seen as well that not only that, but natural gas prices have been so unaffected that down in the Permian, there's even been consecutive weeks of negative spot prices. And so really, and that's been a combination of elevated inventories, pipeline infrastructure constraints, and so they're not able to get that supply out down the pipeline. And so we've seen negative spot prices there, and I think similarly Colorado has not seen had not seen an impact from the Iran war on prices. They're remaining average to below average right now. Part of that is seasonal as well. As we go into spring, there's certainly less demand as well. So natural gas production by state, Colorado is number 9. It's been number 9 the past couple years, so that's been pretty steady. Natural gas is more broad-based than oil production, so you see it there's production, it's more spread around the U.S. Texas is only 29% of domestic production, Pennsylvania at 16%, New Mexico at 9%, and Louisiana at 8%. So it's more spread out around the U.S. compared to oil. And similarly in Colorado, that is also the case. Weld County does lead in natural gas production as well, but it is at a much lower share of about 51% compared to that 80% oil number. And so we see more production in western Colorado, Garfield County, Montezuma, La Plata, as well. And so an interesting piece here. So Weld County, of course, as I mentioned, is number 1 in statewide natural gas production. This was the first year that it actually, in 2025, that it went above 50% of statewide production. A lot of that is associated gas production is taking place while oil drilling. And so that was an interesting note. Garfield County still remains in second with 14% of the share, and Montezuma at 11%, and La Plata at 9%. Rio Blanco at 4%. This is another slide, a similar one I had last year. I added a few things here about where is oil and gas extraction jobs market. And so this goes back to 2014 through the third quarter of 25. Oil and gas extraction jobs, of course, peaked back in 2014. They're around 6,000 now relative to nearly 11,000 back then. The support activities, which is kind of groups in the contract-related activities in the space, of course, have also dropped since then as well. Overall, about 5,000 fewer direct oil and gas extraction jobs, nearly 10,000 fewer supporting jobs. So about a 50% decline in these sectors. However, oil production in Colorado was 78% higher than 2014 levels. And we're seeing that because of productivity gains, drilling efficiencies. So I thought this last bullet here was pretty interesting that compared relative to each employee, there were 3,305 barrels produced per employee in 2014, 7,864 in 2019, and over 10,000 in 2025. So certainly seeing a lot of efficiency gains in the field with lower employment. So where's production going? Industry's been pretty divided, at least this is the Dallas Fed Energy Survey from March, on whether or not to increase drilling because of the elevated oil prices. Some uptick in production is expected, but it's basically a 50-50 situation where some firms are looking to increase drilling, others are monitoring the situation. And it all really depends on how long does this conflict go. Certainly, the quicker a conclusion comes, the quicker that prices will begin easing. Industry expects WTI prices in this survey back from March in 2026 at $74 a barrel. So they do expect it to come down from where it currently sits. But I think that'll kind of be the story. The longer it goes on, if the price environment stays higher for longer, then some uptick in drilling will be expected. Not a huge amount expected right now because the market just doesn't expect that prices will remain that high for that long. So market expectations over the next couple of years. So this, again, was from the Energy Information Administration forecast and Moody's from March. And so this is different in April. Basically, you can bring all those numbers up a little bit because they do have a higher price forecast now. But generally speaking, the trajectory remains the same where they kind of see this spike in the second quarter of 26, and then it kind of begins to come down over the course of 26 and really begin to kind of normalizing back to average to maybe slightly above average levels in 2027. Production side, so on the right, basically the EIA expects flat U.S. production, slightly positive year over year in 2026. Expect growth on the natural gas side. In 2027, expects some more production growth. And then on the natural gas side there, that bullet point, EIA forecasts Henry Hub prices at above average for the year, averaging 376 and 385. Moody's is more bullish. I did see in their April forecast, they brought those down some. I think they're seeing kind of the same things I mentioned where there's a lot of supply out there and prices, U.S. prices are not being impacted by the war at the moment. So for Colorado, slow growth trajectory continued in 25, slightly positive growth. There's been about a 3% CAGR since 2021 for Colorado production growth. There is some room for production optimism. We have a higher rig count in this state compared to last year, 11 this year compared to 8 this time in 2025. There's an elevated price environment, but that may not be sustained. We'll see. So slow but positive growth is expected again in the current year. Natural gas, we saw 5 consecutive years of flat or negative growth. In 2025, saw positive growth. In the second half of the year, even saw relatively strong growth at 2.5%. So expecting to see growth continue in 2026 at moderate levels. And then finally, that part at the end, this is from the Kansas City Federal Reserve, so more regional. Of course, it includes Oklahoma and parts of New Mexico as well, but profitable price for oil, $61 a barrel, or 75 to substantially increase drilling. We are, of course, above 75, but again, it comes back to will it be sustained? Will it be for a longer period of time, or is this going to be a blip and we'll go back down to average levels? Henry Hub, profitable at 380. We'll see how the summer, certainly it seems like right now for this quarter, for the spring, it'll be below those levels. We'll see what happens in the summer when some more demand ticks up. So that's the economic side. I'm going to turn to the revenue side of the equation. And so I'm going to start with severance tax here. Severance tax is mainly about oil and gas. So there's coal, there's metals, molybdenum. That's always a tongue twister. But 96% of all the revenue for severance tax comes from oil and gas, so that is the primary focus. Over the current fiscal year for the state and these next couple of years, we expect severance tax revenue to be just above average. So the orange line is kind of that 20-year average. The light blue bars on the right are kind of the forecast period we're looking at. We expect revenue to kind of be at or above average. The current highs in oil prices aren't going to have a real big impact on the current fiscal year because that ends June 30th. And so we might have a couple months of higher revenue, but it's not going to impact the full fiscal year. Generally, we are kind of baking in 3 to 6 months of elevated oil prices, kind of above average oil prices that will trend down, similar to what the market expectations that I showed you. But oil prices still are expected to fall close to average levels as we get into 2027, and so that forecast kind of represents that. Severance tax is very volatile. I think if anybody who's ever been a part of any of these conversations knows that. This chart just shows you monthly collections over the past few years. The average in all that is $17.5 million, but it ranges from $184.3 million to negative $94.6 million, where taxpayer refunds were higher than revenue coming in. That's how you get a negative number. But it ranges quite a bit. This makes it difficult to forecast. It makes it difficult to accurately estimate revenue that is eventually distributed to local governments and water projects, since half of the severance tax revenue is distributed to Department of Natural Resources for water and operations, and for another 50% to DOLA, with that being distributed back to local governments. And so it makes it difficult to forecast. This is our current forecast of what we expect distributions to be. So certainly expect them to be higher than this past fiscal year, where we saw a lower revenue amount after a few years of very high revenue amounts. So expect that to kind of normalize back to around average levels over these next few years. Federal mineral lease is another big component of oil and gas revenue. The makeup's a little bit different. From federal mineral lease, about 50% is from natural gas, the revenue the state receives, 25% from oil, and about 25% from coal and carbon dioxide. This is remitted to the federal government, but then about half of it comes back to the state. And this is the forecast for federal mineral lease. I highlighted the local side. Expected to be kind of around average levels, given kind of where our price forecasts are, production forecast. Kind of expect average revenue in these areas, about 110 million, with those with a lot about 40% of that distribution goes to DOLA for distribution back to locals or through the grant process. State land board revenue is another significant oil and gas related revenue source. So about 2/3 of the revenue represented here comes from oil and gas royalties and rentals. So we've been hovering around 300 million over the past few years. 50% of that revenue is distributed for K-12 school capital construction, and then basically the remainder is remitted to the state's permanent fund and is distributed there. Oil and gas production fees, this is another one that started this fiscal year. It started July 1st. And so this fee is based upon a sliding scale of oil and natural gas prices. And so for each barrel of oil produced, each 1,000 cubic feet of natural gas produced, there is a fee applied. The revenue from these fees will be used to expand transit service, frequency ridership, fund passenger rail projects, and to fund wildlife and land remediation services as well. So this is the forecast. This in March, when we published our forecast, this was the first time we actually formally forecasted this. And so expect 82 million in the current fiscal year, growing to about 154 million in the next year, and 126. And so then the gray areas show how that's distributed out. 51 million to the Clean Transit Enterprise, 31 million to Colorado Parks and Wildlife in this year, and then growing over these next couple years. So all told, what I just walked through, it's about $550 million in state revenue for the current fiscal year of what we're expecting to be remitted from oil, like directly from oil and gas related revenue sources. However, so there's quite a few different state revenue sources, but all those revenue sources, most oil and gas tax revenue is remitted at the local level. And so this is where, this kind of shows where statewide oil and gas assessed value has been over the past few years. We see the big jump back in tax year 2023. That's coming off of the 2022 very high price environments, both oil and natural gas, very high price environment that year. So we've kind of seen that tick down over the past couple of years as prices began to normalize. But at the local level where oil and gas is prevalent, this is a very important component of property tax revenue for school districts, city and county government, special districts, junior colleges. Generally speaking, as I mentioned, it kind of follows where's price and production of oil and gas going. So if you translate, and this is an estimate, I will say, because there isn't an actual published number for this, but what that $15.1 billion in assessed value on the chart shows for tax year 25 kind of translates to around $1.2 billion in property tax revenue from oil and gas statewide. Now, a lot of that, most of that, 70% or so, is remitted in Weld County, as we walked through, where a lot of the oil and gas production is. But other counties have significant property tax revenue from it as well: Adams, Garfield, Arapahoe, Broomfield, La Plata, Rio Blanco, and Montezuma. So this is just an area where it's a very important revenue stream. And not only is it an important revenue stream for locals, but also has an indirect impact on state finances as well, because when this revenue is, this local revenue is used for school finance for K-12, it also reduces the amount that the state has to equalize for K-12 funding as well. So it's an important piece at the local level, but also important for the state as a whole as well. Main takeaways. So the main takeaways are that I think I had something about our highly uncertain last year, and we're highly uncertain again this year for different reasons. But a lot of geopolitical turmoil, the war in Iran, it's hard to know where that's going to go. As I said, I put this together a couple weekends ago, and I sit here now and there's been a ceasefire and it's kind of holding together. The U.S. has blockaded the strait. I mean, there's been many things that have, it's a very developing situation. It's hard to know where this goes. And so that makes it hard to forecast where we are going. Of course, the quicker there is a resolution, the quicker the market will normalize. It may be slower than expected because there's been a lot of production shut in some Middle Eastern countries. So with that, it might be a longer lag time to get everything back to normal. But obviously, the quicker it happens, the better. And then, a sustained conflict will lead to higher oil prices for a longer time as supply would become increasingly constrained. As I mentioned, most forecasts expect prices to normalize the second half of 2026, although that has been pushed out in their April forecast. That was based on their March forecast. So they're really pushing it out a little bit more into really maybe the final quarter of this year, maybe 2027. So expect some normalization, but they are expecting prices to be a little bit higher for longer. And then finally, Colorado, with all that in mind, state and local tax revenue expect to remain healthy in 26 and 27, expecting those moderate production increases, and with average to above average oil and gas prices should lead to healthy state and local tax revenue. With that concludes my presentation, and happy to take any questions.
Encourage everybody to queue up right away so we can get to the questions quickly. If anybody has any questions for them. That must have been the perfect presentation.
I'll just get us back on schedule.
He always does a great job. Thank you, Will. That was awesome.
Thank you.